Julian, can you put your finger on one thing that is spooking the market today?
You really can't, actually, because when you think about it, I would say if it is one thing, it's that Chair Powell put a dose of cold water on what has been happening. We've had an enormous run since the March 23rd low, and in fact, the good news is that run, led by cyclicals, actually augurs well for potentially new all-time highs next year, but it's been such a huge run that it's really discounted the risks to the reopening, whether it's the virus resurgence or this whole idea that the Fed is a lender, not a spender. And at this point, we've been saying this for quite some time, the politicians in Washington have been dragging their feet on this next round of stimulus, which the Powell himself has been telling you is necessary for 2 months now. So it's really a confluence of things within the scope of an historically large rally.
So, Julian, I was actually surprised to the extent of the sell-off this morning because based on what Fed Chair Jay Powell's talked about in terms of asset bubbles, that kind of doesn't care, that he's much more concerned with the underlying policies and that the asset bubbles will just continue until inflation becomes an issue. That, to me, is like, hey, green light, go buy stocks. Why is that not the story today?
Well, I think because again, this whole idea of lending, not spending, tells you that there are limits. We've heard this phrase throughout financial history, don't fight the Fed. And clearly, up 59% off the lows in the Russell 2000, up 47% off the lows in the S&P and the NASDAQ, that certainly worked. But the difference this time, and it is different this time, is that you have a situation where, particularly small business USA, it cannot necessarily take the liquidity if they don't believe that their business is going to be, long run viable and that you're going to be able to claw back to a good percentage of where you were before the virus. Yeah. So it really is, it's the balm of the Fed that it has a limited shelf life this far off the lows.
Julian, I guess you bring up a really interesting point there, which is that over the last few days, even weeks maybe, we've been focused much more on the liquidity side than the virus side. We just haven't had the conversations about the virus that we did a couple of months ago. Is the market going to refocus its attention back on the impact that the virus is going to have? And does that create a more balanced environment with two-way risk as traders look at how they're going to be positioned?
Well, we do, in fact, think that two-way risk is part of the market right now. And frankly, given the froth of the retail participation we've seen over the last several weeks, and I think, a lot of the rally of the last couple of weeks is very much the retail buyer, the marginal price setter, particularly when we've seen something like the moves that we've seen in some of these bankruptcy stocks. And I think you can actually argue that while we're waiting for, the medicine to catch up, while we're taking, the statistics of what the reopenings are going to look like, it could, in fact, be a healthy thing that the market either marks time sideways or drifts a little bit lower.
Julian, a lot's been talked about of how there's a lot of cash still on the sidelines, how positioning within the S&P still isn't overdone, that we're kind of around neutral. The theory, at least yesterday, was that there's still a lot of cash on the sidelines, like waiting to come in, which would propel stocks with another leg higher. Does that happen now, or does it get pushed off? What are your thoughts?
I think you need to see at this point, sort of a better feeling about the fundamentals. If you look at the last 3 or 4 weeks, again, as Guy pointed out, the virus has been in the background. And it could well recede into the background once again if we find a week or 2 weeks from now that the places where there's been social unrest don't see spikes in cases. That having been said, the money that's there, and we look at that $5 trillion pile sitting in money market funds, which we do eventually think will find its way into equities. For now, that's a cash trove that's likely to cushion consumption in the case that we don't get the sort of economic recovery that the market has implied over these last number of weeks.
A lot of people are still looking for better entry points, Julian. You talked there about the kind of the Robin Hood rally. That's what people have been focusing on for the last couple of weeks. If that money were to get burnt and start to roll over, how much of a catalyst could that be for a retest? I'm trying to figure out what could cause us to retest the lows, because that would be the historical norm.
I don't think that money per se is likely to be that significant a downside catalyst. Look, you used the phrase, that was fast money. Okay, that's the kind of money that we saw the public participation at the end of January and the beginning of February that gave us cause for concern. That's the kind of positioning that along the entire rally that lasted 10 plus years, we thought were catalysts for a sort of a 10 to 15% correction as the frost gets blown off. The market is a bit more volatile now, obviously, with VIX sort of sticky at 30. That number's more like 15%, but we think it would take a material deterioration in either the public health situation or, because of the public health situation, the speed of the economic reopening. The positioning itself, again, because you mentioned professionals have actually been largely underweight this rally, positioning itself will not cause a retest.